Today, another sea of red. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. This is just a quick update to discuss what happened overnight in the US. There was another significant downturn. In fact, the indices continued their slide as investors worried about rising interest rates and continued to brace for the trade war hit on corporate earnings. And of course, in the US, the quarterly reporting season starts off very soon. It was actually the sixth consecutive day of declines, with the S&P closing down 2.1% after shedding 3% on Wednesday. But it was highly volatile, and in the session low, the benchmark fell 2.7% to its lowest level since early July. And in fact, the Nasdaq narrowly avoided a technical correction, i.e. more than 10% move. During the session, it fell as much as 10.3% from its August 29 closing record high, but ended the day 9.6% below the record. Of course, investors are worried that equity markets are going to have trouble recovering as rising interest rates coincide with uncertainty about how much earnings growth will be hurt by the US trade war with China. So the Dow Jones Industrial Average fell 546 points, or 2.13%, to 25,053. The S&P 500 lost 57 points, or 2.06%, to 2738. And the Nasdaq Composite dropped 93 points, or 1.25%, to 7,329. And the Volatility Index, or the Fear Index, ended the day up 2498, its highest close since February the 12th. The intraday high was 2884. And in fact, through the day, there were various attempts at a rally, but it ended up being a sucker's rally. And I think the expectation has to be that there will be more downside ahead. In fact, the S&P's 11 major sectors all ended the day in the red, with only communications services managing a decline of less than 1%. Energy was the biggest loser at 3.1%, but the financial sector fell 2.9%. The technology sector, which was the biggest loser on Wednesday, closed down 1.3% on Thursday, which suggests that the falls are much broader than just the tech sector. The 10-year Treasury yield dropped a little, but the expectations remain that ahead rates will go higher. Gold ended pretty much flat at 1,227. Bitcoin fell 4.75% to 6,297. And the Aussie is currently at 71.20, which is up from yesterday, but is still looking relatively shaky. So the discussion now has to turn to what may be ahead. The question is, will the free-falling share price drive the US Treasury yield under 3%? The value of US common equity was recently 7.4% under its record high of the 29th of August 2018, and in the event the equity market sinks 10% under its current height, the containment of inflation expectations supplies the Fed with more than enough leeway to temporarily halt its ongoing normalization of monetary policy. Never before has the Fed simultaneously firmed policy by both hiking Fed rates and reducing its holdings of Treasury bonds and agency mortgage-backed securities. So it is possible that the drop by market value of US common stock may prompt the Fed to either downsize or halt the ongoing passive reduction of its Treasury bond holdings. And the broader information from the US is not altogether positive. For example, the new and existing home unit sales for the 3 months ended August 2018 were 4.4% under their current cycle high of 2017's final quarter, when the US Treasury yield averaged 2.37%. Once the moving 3-month average of total home sales is 8% under its highs of 2017 final quarter, the 10-year Treasury yield will probably begin to decline. And it's worth also highlighting that President Trump tweeted that the Fed was actually lifting rates too quickly. So to sum up, the stakes are rising and the amount of uncertainty in the system continues to increase. And it will be a battle between more rate rises ahead as the Fed tries to lift and the broader economic outfall of too much money in the system for too long now being withdrawn. I think the net of all this is that, one, we're going to see a lot more volatility over the next few weeks, and two, the Fed will find it difficult to lift the rates as fast and as far as it wants to. And as a result, the quantitative easing impact will continue to flow for some time. However, the bottom line is this: I think the Fed is probably right to try and reduce the artificial stimulation from QE. After all, we've said several times that effectively over the past 10 years, there has been very little done to tackle the underlying issues that have driven asset prices way too high, and that simply cannot continue. If you found this useful, please like the post and add a comment or question. I read them all. And if you haven't subscribed so far, please do so to receive future updates. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.